After decades of falling tariffs, the world is going back in time. After the announcement of new tariffs on a range of countries, the average US tariff is forecast to rise to over 22%. This is the highest rate since 1910, higher than the Smoot-Hawley period of the Great Depression. Since 1945, free trade has been a driver of economic growth across the world, but this new range of tariffs is so extensive it is literally throwing everything up in the air. Of particular note, tariffs on China of 34%, EU 20%, Vietnam 46%, UK 10%. And don't forget Heard and McDonald Islands, remote islands with zero population, but now with their own tariffs on exports to the United States. Back in 1945, the United States accounted for over 40% of global GDP. Its dominance allowed it to effectively set up the global economic system. But the era of US dominance is slowly unwinding, and maybe this will accelerate the process. Despite relatively good economic performance, the US is declining as a share of global GDP. Measured in purchasing power parity, it was overtaken by China in 2017. In dollar terms, the US economy looks bigger, but with these new tariffs and economic policies, we could well see the decline in the dollar as a reserve currency. Don't forget global reserve currencies like the Dutch guilder and the pound sterling all had their moments in the sun before their inevitable decline. Now, there's no certainty about how long these tariffs will be maintained. Recently, Congress voted to end the president's tariffs on Canada. It is feasible they will be reduced to some extent, but also it's very feasible that this new era of high tariffs is here to stay. It will depend a lot on how major economies respond, but both the EU and China are expected to introduce retaliatory tariffs, and who knows where that will end up. And this will, by the way, hurt US exporters such as farmers who are actually slightly less protected than European farmers. Now, President Trump has admitted that tariffs will cause short-term pain, but in the long term, manufacturing jobs will come back to the United States when firms relocate to avoid tariffs. Now, certainly in the short term, markets agree about the short-term pain. A big sell-off has caused stock prices to fall 10% since its mid-February peak. Gold, a notable hedge against uncertainty, has also been hitting record highs as investors look for security. It is worth bearing in mind the stock market is not the economy. There is an old saying that the stock market has predicted at least 10 out of the past 2 recessions. Shares were overvalued at the start of the year, but this is more than just a correction. Big multinationals see these tariffs as a much bigger cost. It will lead to higher prices, higher costs, lower trade, lower economic growth, and this is all bad news for a company's bottom line. Now, one motivation for the tariff appears to be the fact that the US is running a large current account deficit, a large trade deficit. It means Americans are buying more goods and services than they're exporting. As a result of importing so many goods, the US manufacturing jobs has declined from 19 million in 1980 to around 12.5 million today. But it is worth bearing in mind that with a trade deficit, what it actually means is on the other side of the coin, the US has a big capital account surplus. That's money coming in to buy US bonds, US treasuries, or foreign firms investing in US factories. Now, in a way, the large current account deficit that America has is actually a reflection that the US economy has been doing quite well. It's been doing better than Europe, higher productivity growth, higher economic growth. And so this is causing people to want to invest in America. And if you look at the other extreme, Germany actually has a huge trade surplus, one of the biggest in the world. But that really reflects quite weak domestic demand, weak economic growth. And it shows also that even with a trade surplus, you can have a decline in manufacturing. Germany has gone through deindustrialization in the past few years, a fall in manufacturing jobs. And by the way, these latest tariffs are a real big problem for Europe and Germany in particular. Germany, an export-led economy, very vulnerable to these higher tariffs when your model is relying on export-led growth. European markets have fallen quite a lot, with good reason to be fearful about where the trade war will lead to. Now, in the short term, this big range of tariffs will lead to higher prices for American consumers. Capital Economics believe that the US inflation rate could rise to 4% by the end of the year. Now, US consumers are even more pessimistic, predicting inflation will go up to 5%. In truth, tariffs are more of a one-off shock to prices. it's unlikely to lead to the kind of continued inflation we saw in 2022. But perhaps the biggest problem is not actually inflation, but the risk of an economic slowdown. Mark Zandel of Moody's suggests a recession is almost inevitable if all these tariffs are actually implemented. Goldman Sachs suggested that the effect of these tariffs could be much greater than they thought a few months ago. It could lead to a loss of GDP of around 1.3%, which could be a tipping point to push the economy into recession, also creating negative confidence for both firms and consumers. Now, one reason for imposing tariffs is that they raise revenue for the United States federal government. Currently, tariffs raise only a measly $80 billion a year. But according to the non-partisan CBO, these new tariffs, which are very extensive, could lead to an increase in tax revenue of around $2.2 trillion by 2034. Now, the idea actually is that tariff revenue will fund tax cuts. And if this source of revenue becomes quite important to the federal government, then it may well become much harder to reduce tariffs in the future because free trade will then require higher taxes. Now, an interesting question is, will manufacturing jobs actually come back to America? If tariffs are maintained for long enough, then foreign car firms will have an incentive to start producing in America. But there's going to be no short-term fix because, firstly, investment is quite expensive, takes a long time, and there's no guarantee where tariffs will be in 4 years' time. Also, even if there is some more investment in, say, building car factories, there's unlikely to be a return of the manufacturing jobs of, say, the 1960s, 1970s. Car firms are much more automated these days, needing fewer workers. And the US is basically a service sector economy. And don't forget, it's not just the US which has seen a decline in the share of manufacturing. It's actually something occurring across the globe, even in China, manufacturing a smaller share than a few decades ago. Now, what about the bigger picture, about the role of the dollar and things like the WTO? The WTO, the World Trade Organization, was effectively the creation of the United States. But now the United States no longer abides by its rules. As a result, countries affected by these tariffs are no longer interested in trying to salvage the old order. They're just creating something new. We've seen the growth in prominence of trading blocs like the European Union, but also the Trans-Pacific Partnership, which links Canada, Australia, Chile and Mexico. There's even talk of closer ties between Canada and the European Union. Might have sounded outlandish a few years ago, but now less so. There are also the group of emerging economies like Turkey, Brazil, India and Indonesia. Now, these countries tend to rely on exporting to America and China for capital investment, so they tend to try to avoid aligning too closely with either. There's a growing partnership in Southeast Asia, with Australia and New Zealand joining the Southeast Asian economies. But China is at its heart of many of these new trading blocs. China's dominance in manufacturing in exports continues to remain very strong. So the changing nature of trade partnerships sees a more diffuse and devolved global trading order. The old global WTO superseded by more fractured regional agreements. It also reflects the growing clout of emerging economies and China in particular. Certainly the dollar has defied recent predictions of its imminent demise. It still is a major reserve currency, and that's not going to end anytime soon. But this new experiment in tariffs is speeding up the fact that investors are wanting to diversify from putting all their eggs in the dollar basket. And of course, it's not just tariffs, but the 2022 sanctions, and this encouraged many emerging central banks to start to buy gold, one reason behind its big rise in recent years. The global economic system is undergoing big change, and who knows where it will end up in a few years' time. The old order is kind of been swept away. Quite interesting from an economic perspective, but it could involve quite a lot of short-term costs, possibly even long-term costs too. Hopefully it won't be as bad as the Great Depression in the 1930s, but a risk of recession is definitely higher than at the start of the year. If you're interested more in the price of gold, this video looks at why it's been doing so well in recent years and whether its run could be set to continue. Cheers.